Welcome, everyone. First, my name is Chad Narani. I'm a retirement plan consultant here at BFSG, working with our institutional and corporate clients, helping to design and maintain their 401k programs, from investments to costs and all that other things that go into a 401k program. Let me pass it over to our team of certified financial planners we have here to address your questions today.
Hi, everybody. My name is Sophia Liu. I'm a certified financial planner and also a chartered life underwriter with BFSG. And my role within BFSG is I help a lot of people with their personalized customized financial plan in terms of achieving their goals, such as retirement or major house purchases, etc. And it's a pleasure to be here today.
And Mr. Scott Sellers, you are muted.
Hello, everyone. Good morning. My name is Scott Sellers. I'm a certified financial planner and an accredited investment fiduciary. I work out of the Phoenix Wealth Management office, and my role is predominantly financial planning and investment management for our clients, both individual as well as families and businesses. So happy to be here today. Look forward to your questions. Thank you.
Hi, everyone. My name is Paul Horn. I'm the Director of Financial Planning here with BFSG. So I help oversee all the financial planning activities for the firm.
Hi, everyone. I'm Henry Van Buskirk. I'm also a certified financial planner with BFSG. I work with individuals, businesses, and participants on creating and constructing financial plans. I also sit in on our investment committee as well, and happy to be here today, and thank you all for taking the time.
And Mr. Michael Albee.
Hey everyone, happy to be here today. I'm a CFP professional, been with BFSG for 17 years now, and I'm a senior portfolio manager focusing mostly on investment planning and strategies, but also working with our clients on financial planning.
I love it. And so again, well, I actually already have a question in the queue here, and I know we're gonna do a poll in just in a minute as well. But before we get into that, Paul, can you put up just on the screen real quick? I know we have one prepared slide and then a million slides behind this to answer questions, just to show some of the topics that we're all prepared to address with everyone. So again, instead of a prepared presentation, any topic on this page, or really honestly, any topic not on this page that might impact your investing or financial planning, your budgeting, savings, any of those goals that you might have as you work through your career, get ready for retirement. Maybe you're young, just trying to pay off debt, get student loans, all that fun stuff. Anything that impacts your financial life or your investments, we are here prepared to address today. There might be a chance that we have to say, I don't know. And we have a team of 5 CFPs that might be Googling in the background to find that answer before we have to drop off the call today. And so again, there's also in the Q&A box, the ability to thumbs up. So if you see a question that you really want to have addressed, especially as that Q&A grows from 1 or 2 questions right now to 20 or 30 questions in a few minutes, click the thumbs up rather than asking the same question again. And that will actually drop to the top of our box so we can ask the questions that the audience wants to hear the answers to first and foremost, rather than in the order they are received. So with that, let me launch a poll, because I know this group kind of wanted to gauge the audience in the first place. So I'm going to launch a poll. It should show up in your Zoom menu right now, right on top of Zoom. Open a poll is to get started. What's your biggest financial concern? Right? And that could be young, starting out your career. That could be mid-career, buying a house, saving for college, right? Any of these number of things. We put a number of things on here. But the last one is just to have fun. Way more topics. I'm adding them into the Q&A box to start, thinking about this discussion. So let me close that poll out. I'll share results with the group just so everybody can kind of see it too. I think the 11% of people, or call it 70, the biggest one we have is just having enough money for retirement, right? And so hopefully we have a few questions. I mean, I think we can start off and just make that the first question, some tips and habits. We had 11% of people saying just managing expenses, right? Day-to-day budgeting, it sounds like, or prioritizing financial goals at 13%, home, college debt, et cetera. Building an emergency savings fund, right? The fun fact you hear from the Fed every year is something like 60% of citizens in the United States cannot pay $400 cash if they had an emergency expense come up. And it's always a scary thought when I really put that math in my head. So definitely building that emergency savings fund, having enough money, right? I already have enough money. That's over 20% of people, but how do I transition into retirement? So another great question here that dropped that in the Q&A box, and we're happy to address that and at least give some tips. I think we did an entire webinar on that last year. And then again, way more topics. So again, I'll actually share that on the screen so you all can kind of see that too. But I think just to open this up before we jump to the Q&A box, for all the CFPs, all 5 of you here, whichever wants to jump in first, is any tip you have just to have enough money for retirement in the first place? I mean, I would say the first tip I have is start saving early and save as much as you can.
Yeah, let that compounding work for you. That's the best tip, like you just said, Chad.
Yeah, but like, there's no such thing as getting to retirement having too much money, right? It's like then you could drive a nicer car, nicer vacations, all that fun stuff. So, okay, awesome. So let me jump into the Q&A box group. And so the first one we have here, and I'll plug this to Sophia to start. But what are Social Security and Medicare options if working in government most of career and you only have 33 credits?
That's a great question. So first of all, if you want to qualify for Social Security benefits, you do have to have at least 40 credits. And so if you only have 33, and most governmental agencies, unfortunately, they do not pay into Social Security in terms of your payroll withholding for the tax purposes. However, there might be some exceptions. And if that is the case, for your employer, for example, because there are certain employers that do pay into Social Security even though they are governmental workers. So we'd be happy to take that one off, but maybe Henry, you could chime in if you have anything else to add.
Yeah, no problem. So it is also good to note that the limit for income to collect a credit on Social Security is fairly low. We recently worked with a client who basically decided that she wanted to help babysit her grandchildren and then have the parents pay her some kind of salary in order just to get an extra credit. For example, in 2024, that credit is 1730 in covered earnings. So just means that you need $6,920 to earn the max of 4 credits in that year. So it's a pretty low threshold in order to get those additional credits. But the question of Social Security benefits and how it relates to a government worker, it's a nuanced question. So we're always happy to take that offline as well, just to help out with your individual situation as well.
I would also just want to add with Social Security, if you work for a government and you're expecting some type of pension, there could be what's called the windfall elimination provision, where that could offset your Social Security benefits and reduce them, depending, again, how long you work for the government.
I love it. So the next one I have, and this already actually has a couple up votes, is how do I know I won't run out of money in retirement?
Well, the easy answer there is to do a financial plan. That's going to be your best resource to really have an idea what your complete financial picture looks like. With the financial plan, it's going to help you fully see what it looks like when you can retire, and then it'll help provide some ideas to help maximize retirement. Maybe you can retire sooner than you're planning. Maybe you can spend more money than you think you can. Financial plan is going to help quantify all those sorts of questions. That really is the best and only way that I know of to really measure your ability to retire.
And Paul, can you go to the Social Security slide showing how much that replaces of income? I think that might be a good visual as well.
I'm not sure if we have that exact slide ready to go.
Thought we did. Go to Social Security benefit, maybe. Yeah, that one.
Yep. Oh, perfect.
So this is showing, I mean, depending on your pre-retirement income, how much Social Security may replace, and then where you are going to need from saving in your retirement plan, pension, which most people don't have nowadays. And so saving is really important as well. As Paul noted, I mean, having a financial plan, knowing that you're not going to run out of money, but saving in retirement plans and other savings accounts is really important to offset that, because Social Security is only going to replace, call it anywhere from 25 to 60% of your income, depending on your pre-retirement income. So just save early, as Chad mentioned earlier in the call.
Yep. And just as a reminder, because we have had quite a few people join since I did the opening and housekeeping, that this is an entire session of Q&A. So for all of you that joined after housekeeping, please pull up the Q&A box. You should be able to see every question in the queue. You have the ability to thumbs up them. They'll jump them to the top of our queue as well. But this entire session is a roundtable with certified financial planners and investment professionals to answer questions for the entire duration of today's session. The next question I have at the top of the box group is, this could really go to any of you, but should I pay off my home before I retire?
Yeah, I'll take that one. So there's two parts to that question. There's the mathematical part, and then there's the emotional part. So I always like to start off with, okay, what's the actual rate on your mortgage? If it's say 3%, and then you can earn 4.5% on a CD or a money market or some kind of guaranteed asset, then mathematically it's not going to make sense to pay off that mortgage because you're having that difference of 1.5% in earnings over the life of your plan. But then there's the peace of mind aspect too. A lot of people don't want to enter into retirement with a debt, especially a debt like a mortgage that has been looming over your head for years at times. So it's really working with the person to see what they're comfortable with doing and then showing them both options. And in some cases, they can pay it off just fine, or some cases it's a little bit more nuanced with how much they should pay towards the mortgage in order to have a more successful retirement. It also has to do with cash flow.
Yeah, any of you have anything to add with that? A lot of it, especially if you have a sub-3 interest rate, like it's almost like free money. Is it, could you make more on your investments, right, through retirement and still pay off that mortgage, right, if you have such a low interest rate?
Mhm.
The next one I have, I'm going to pull this from the chat box group, and maybe for Scott. Anything you can advise for clients that are in huge debt and don't have great credit, right? So, hard to get access to a higher limit credit card that might even improve your credit score. Where does somebody like that start?
Yeah, so this is, unfortunately, a lot of folks are in this position, and you have a few options here, and just remember first off that a large part of your credit score is based upon the utilization of your credit limits, and so it would be advisable for a number of reasons to look at paying down this debt. And as they put up on the screen here, there are really two methods to doing so. And I think the overall objective would be to reduce the utilization or how much of your total credit line you're actually using. And there's the snowball method where you pay off the small balance debts first, and then whatever you're paying towards the small balance debts, you then roll that into the medium balance debts, and then whatever you're paying there, roll into the large balance debts. And then the other, and I hear this frequently, and I'm sure my colleagues do as well, which is called the avalanche method. It's where you target the highest interest rate debt first, and then go to the medium and the low. So here's two strategies, but again, to summarize, ultimately it's about reducing the utilization of your credit, and there's just no good way other than just choosing one of these methods and just knocking that down as quickly as possible, because that will improve your credit score.
Yeah, I love it. Thank you, sir. And so, I mean, to that end, I told everybody the Q&A box, please do put your questions there, not in the chat box, but I definitely recommend pulling up the chat box because I've already, for the entire audience, posted 2 links. One, if there is any of those answers, which might happen frequently, that they say, definitely reach out. We're happy to give you more personalized guidance, and it doesn't cost anything for that first call. Reach out, financialplanning@bfsg.com. The second one I just posted, just because it gets back to the basics of just saving and investing, is a few of us put together a financial literacy series that a couple clients requested for their children and grandchildren. That's been very well received. It's 5 parts, 5 to 10 minutes, and it goes through all the basics of saving, budgeting, investing, how to maintain or build good credit. Like all of those things are included in this 5-part video series of relatively short videos. I did put the link to that on YouTube in the chat box. The next question I have for you, and I think maybe I'll start with this one for Mike, because I know you do a lot of the hidden levers risk assessment stuff with clients. Does a low risk assessment score box you into an investment portfolio? And I think this person had someone advise them against using the Vanguard Total Stock Market Index because it was too aggressive for their score.
Yeah, risk score, I mean, it's one input. It's not the everything. You need to know your time horizon, how much time you have until retirement. Your risk tolerance, I mean, is good to know what your downside risk is, because you don't want to get shaken out of the market if you experience a 20% downside in your portfolio and you go get me out and sell out of everything. That's really important. What's your capacity to take risk? Are you going to have a pension, social security, income from real estate or something else? So it's just one input. I still believe, I mean, depending on your risk, you still should have equities in your portfolio, or stocks. It's just what's the right percentage. So to flat out say like you should not have any U.S. stocks through the Vanguard Total Stock Market, um, probably doesn't make sense, but it's specific to your situation.
Yeah, I think a very common strategy is to use that Vanguard Stock Market Index and put whatever percentage your risk tolerance says, but that is a good fund for that. It's very low cost, right? Index option. And then find the Vanguard Total Bond Market Index, right? Or the S&P or the Spider bond, like whatever bond index you want. Just Vanguard is the most common indexer out there. And that's the other piece of your portfolio. And then there's a cash component, right? So some cash, some bonds, and some stocks. But that stock portfolio mentioned in the question is a really good portfolio. We've seen a lot of accounts. I wouldn't shy away from it. Just don't put all of your money into that if you have a low risk score.
Yeah.
And this brings me to one of our polls, actually. Let me launch another interactive poll. We had a ton of questions too, but just because it gets to the heart of investing. Oh, maybe I didn't actually build that poll. Never mind. Sorry about that. We didn't write it. But I have one more. Where to get investment advice? Okay, let me see. Where do you get your investment advice? Sorry, that's what I meant to launch.
Mhm.
And so this could be family, friends. We put some fun ones in there like CNBC and Jim Cramer. A fun just story behind there. There's a lot of people buy the Jim Cramer portfolio. There's also the inverse Jim Cramer portfolio. Ironically, that has done really well over time. So if you always pick the opposite, that portfolio is like done pretty well over the last 2 to 3 years. And so I got almost like very few people saying family, but there are a couple in there, right? Like number of people saying friends. There is some people out there on the Jim Cramer CNBC train. Let me close polling real quick because I could share results with the group and share results. I think that the most telling one here, which is great to see, actually financial advisor or a newsletter from like an advisory firm. I think you get a lot of experts out there. I see somebody else doing it. You're going to be right after people on this calls. The CFP's Dave Ramsey came up in the chat box already, Henry, as a place that people are getting some of their advice. Somewhere else online, right? Social media, TikTok, etc. So like there's a lot of places out there. The one thing I'd always caution people, especially like online social media, is don't get bogged down in the noise, right? Like we just had an election. People are always worried. What does that mean for the markets? I can tell you historically over the last 100 years, the election was irrelevant to the markets long term. So it doesn't matter if it's Democrats or Republicans in office, the markets have been within a percentage point in either of those. So again, I think a lot of people are sharing too. So like I said, Q&A for our team, but I think a lot of participants out there are putting in the chat box just their own experience. And I think every attendee can see that chat box where some of the other participants on this call are getting their advice. Definitely take some notes on the side from that chat box. The next question I have for the group that is, again, at the top of the box here is, should I get long-term care insurance? And so I think let's do either like Henry and Sophia. What are your thoughts there?
Yeah, I'll go. So with long-term care insurance, the first question that we're looking at is, can you self-insure? And the reason for that is long-term care insurance is fairly expensive. And the only thing that you need to do with the insurance company is as long as you continue to pay the premiums, they will keep the policy in force. However, that doesn't mean that they can't just jack up the rates 30% a year or 30% even in a quarter. So long-term care insurance is fairly expensive. So we look at the current assets that the person has and see, can you pay out of your current cash flow, your retirement assets, maybe even home equity if you absolutely have to. And if the case is you can self-insure, then that's something that we might recommend doing. And then if long-term care insurance is appropriate, then we always have referrals that we can refer you to if need be. But again, the insurance policies themselves are very nuanced. They can run in various different chassis, like a traditional policy where all you get is long-term care insurance. That's it. There's no bells and whistles. Or you can have it within a life insurance wrapper where it's in the form of an accelerated death benefit. So if there's also some kind of life insurance need, then you can basically access that death benefit for long-term care need while you're still living in an accelerated fashion. It's really more of a nuanced question, so I'm always happy to do the plan to see what that looks like for you. And Sophia, do you have anything to add?
Yeah, I would say, long-term care, the cost of long-term care definitely has been a rising concern for many years now because we have a lot of baby boomers entering and just the need or the demand is there, but the supply is lower compared to the demand, right? So the prices are definitely rising. And to your point, Henry, we would recommend clients to self-insure if they could. But most of the time, if you are considering long-term care policies, there are certain things to look out for, right? In terms of what is going to be your monthly benefit and what is the waiting period. And also, does it have inflation clause built into that to combat, rising cost of long-term care in the future? Perhaps for someone you're considering long-term care when you're in your late 50s, right? Let's say the monthly benefit is $4,000, right? But, typically long-term care, you don't, let's say it happens when you're 75, right? $4,000 today is very different than 20 years later. So again, it's a nuance, it's a lot of different factors that goes into this. And so if you want to, we can always take a second, serve as a second pair of eyes to take a look at it before you pull the trigger, because a lot of times we see clients, they pull the trigger on something and then later on they regret it. One, either because they no longer need it, or two, they don't really understand how it works and how they can benefit from it. So we always stress, right? We want to make sure that you understand what the decision you're making before you do so.
Yeah.
I would just add, unfortunately, costs have been going up a lot. Clients in current long-term care policies are seeing annual increases of 15, 20%. So you've paid into it for all these years, and now you're looking at companies coming back to you going, hey, your premiums are going to continue to increase, or we can reduce your benefits for a reduced premium. And so it's also the capacity to pay for it. I would just plug if you have the ability to do a health savings account. It's triple tax free. It's a great way to save for health events in the future. So check out a health savings account as an option.
Yeah, I love it. And I think before I get to the next question, is to note, like, all of the financial planners on this call, they're all fiduciaries. BFSG does not sell insurance. We don't sell annuities. We don't sell long-term care insurance. We don't sell any of that stuff. That this is truly meant to be educational advice. I mean, you can bring them quotes to review and they would help you with that, but they're not going to be the ones that sell you that policy. So there's no like side backdoor things we're trying to do here. The next one, this is not the top of the thumbs up, but because it's so related, I know we're going to go back and forth on a million different like estate planning to insurance, et cetera. But because it's so related, what do you guys all think about just universal index life insurance? And why do people not tend to get it these days?
Well, yeah, I would say that there's no such thing as a bad policy because the policy is just as it's constructed by the insurance company, whether or not you sign that contract, that could put you in a bad situation. So it's really understanding what you're purchasing and what your actual needs are. Typically, people only need life insurance coverage for a finite period of time. That's why we usually recommend term insurance because it's more economical for you. And there's some cases where it could make sense with estate planning, like things like a irrevocable life insurance trust, where a cash value policy could make sense. But a lot of the reasons why you hear bad things about universal index life insurance is they're complex products with the cash value that's dependent on an index made by the insurance company that works maybe like you think it does, but it probably doesn't because it's not including things like dividends if you're in like an S&P index option with that, for example. So you think, oh, the S&P did 10%. Why isn't my account doing 10%? It only did 5. Well, it's because it's only looking at the price index. Oh, on top of that, there could be a cap of say 3% growth potential on each index option. So taking that example further, saying, okay, the S&P did 10, but then we take out the dividends, it only did 5. Wait, why am I only getting 3? Okay, well, there's a cap on it. So I say all of that just to explain that these products are very complex, and just to make blanket recommendations on life insurance is not appropriate in any case. So that's why we want to start with the financial plan to first understand what your coverage is. And then from there, what kind of life insurance product would be most appropriate in your case.
Yeah, I love it. Very thorough response, Henry. Thank you.
No problem.
Next one I have group is a way different topic here. Can you explain cost basis and what gets stepped up or doesn't get stepped up with a trust versus a retirement account?
All right. So this is more of an estate planning question. So when someone dies, there's assets are split between taxable and tax deferred or Roth assets. Here is kind of a nice way of kind of showing those different buckets. So what happens on assets that are taxable, which are typically going to be like stocks and bonds, if they're held in a taxable account. A taxable account is an account that's either in your name, maybe you and your spouse, or in the name of the trust. That's an account that has to pay taxes each year. So what happens on the date of death? Those assets held in a taxable account. On the death of an individual, that asset receives a step up in basis. Basis is the cost that they paid to buy that stock. So let's say they have a portfolio of 200,000, and let's say when they invested that portfolio initially, it was 150,000. So the cost basis on that portfolio is 150,000. If everything got sold, you would have 50,000 in capital gains. That's the 200,000 balance minus the 150,000 cost basis. So you'd have 50,000 in capital gains there. Well, what happens is when someone dies on these taxable accounts, the cost basis gets a step up and becomes the value of the assets on the date of death. So now the people that inherit that account, they don't have to worry about that 50,000 in capital gains. Now their cost basis is the same as the market price on the date of death. If they sell the assets, there's no taxable events there. So the step up applies to any asset that is not a retirement account or in a tax deferred account. Roth accounts and tax deferred accounts like traditional IRAs, traditional 401ks, 403bs, those assets are typically tax deferred. So those assets have never had taxes paid on them. So the cost basis is essentially zero. There's no cost basis. So those do not receive a step up in basis. So an easy way to think of this, retirement assets, no step up, taxable assets, step up in basis. That's somewhat of an oversimplification, but that's an easy way to kind of think about it.
And real estate would be part of that taxable bucket where it's going to get a step up in basis as well on primary residence.
Yeah.
And with the Secure Act 2.0 that passed a few years ago, when you inherit those retirement assets, now you have to deplete them over a 10-year period from the date of death. And starting next year, required minimum distributions on those. Anything coming out of a Roth would be tax-free. Anything coming out of a tax-deferred account like an IRA, 401k, or 403b would be taxed at ordinary income. There's no avoiding taxes on that piece of it.
Thank you all. Next question is, this person's retiring at 62, How and who do they pay for healthcare?
So at age, Scott, do you want to answer this one?
Sure. So retiring at age 62. So earlier in the conversation, Mike had suggested a nice way to save for healthcare expenses later on in life as a health savings account. So we would encourage the contributions to the health savings account to help supplement that period of time from, say, age 62 to the time you qualify for Medicare. So that's one way to do it. The other way, that comes to mind is, well, is there another way? I guess, Paul, I toss it back to you to help out
No
there.
problem. Yeah, so for an individual, so typically, most people, retirees are covered by Medicare. Medicare doesn't start until age 65. So for an individual that retires before 65, typically one of two things happen. You'll have access to what's called COBRA, which is allows you to keep your employer's benefits for 18 or 24 months after you leave, but you have to pay the full cost. It's no longer being subsidized by your former employer. So that's one option. So if you're like 63, 63 and a half, maybe 64, that might be a good way to go so you can maintain the same coverage until Medicare kicks in at 65. For someone that's retiring like 58, 60, COBRA is not going to meet your full needs. For those individuals, you can go out and get a private healthcare policy, but I'd say more than 90% of the clients that I work with that retire early, early being before age 65, what they're typically doing is just going to the healthcare exchange in their state and just picking out a policy there. So that tends to be the most common way that people get insurance. And it can be split where maybe you have a spouse that's 66 and another spouse at 62. The spouse at 66 goes on Medicare, but the spouse at 62 still has to go out to the exchange and get that policy for themselves until they're 65.
Okay, so next one I have here, I got two with two thumbs up, but I'm gonna ask the one that had two first. If I have a 401k from a previous job, should I roll it over into my current 401k or into an IRA? I think pros and cons of each. I'll start with that one. So I think it definitely depends. It depends on the type of employer your former 401k was with and the new employer. The costs can vary greatly, right? And I come from our institutional business that helps institutional clients and corporate clients with their 401k. So it's near and dear to my heart, right? Smaller 401k plans, like smaller employers, typically have more expensive 401ks. And most of the expenses are passed on to employees. Even if you don't know it, it might be baked into a mutual fund expense ratio. It might just be a hard dollar cost. Larger employers, just because they have economies of scale, right? Like $1 million plan versus a $1 billion plan, there's different levels of money. And the big providers out there, from the Fidelities and the Schwabs and the Aons and Powers of the world, they charge less for bigger accounts because the dollars are still bigger, right? So a smaller fee on a bigger account as a percentage of assets is still worth more to that from that large employer. So if you're coming from a Fortune 500 company to a small employer, it might make sense to roll to an IRA. It might also make sense to leave it with your former employer, right? That former employer probably has a really inexpensive 401k plan and really good investment options. They likely work with a consulting team like BFSG or one of our competitors. And if they have a very competitive plan, leaving it there may be an option for you. Or rolling it to an IRA where you manage it yourself may be an option for you. But that said, if you don't have the investment expertise to manage it yourself, most 401k plans have asset allocation tools that will help manage the money for you, like things like target date funds, et cetera, that give you the right mix of stocks and bonds. So it also comes down to your expertise. The other side, you might have come from a small employer to a larger employer. And maybe it does make sense to roll it out because smaller employer, again, higher fees. Maybe the larger employer has a cheaper or less expensive 401k plan from an overall fee perspective. Even the mutual funds can be less expensive. Again, so there's no right or wrong answer to that. There's pros and cons of both. It comes down, I think, to your investment expertise in the IRA versus the size of employer and honestly, the management of account. We've taken on some very large clients, right? Almost $1 billion in 401k assets. So you're talking very large employers. and it was a very poorly run 401k plan. So, right? So just because you're moving from a smaller employer to a larger employer does not mean that larger employer has a better 401k plan either. So I think you definitely want to look at the statements, look at the documents, look at the investment options, and seek advice from a financial professional that can help you kind of weigh the pros and cons of both. Anything to add from the group? I got shaking heads. Awesome. So the next one, this is near and dear to my heart. I can give a good example too, but I'll let you address it first. For tax purposes, thinking about somebody that's in a relationship, maybe married, maybe not at this point. I can't tell from the question. But is it better to file single or married, assuming these people have relatively similar incomes? They're deciding whether to file for marriage. Is that even beneficial in this regard? I can tell you just to start, when I got married in the first place, my brother is our CPA and is a longtime CPA, and it cost us thousands of dollars in taxes when we started filing jointly. But obviously, in marriage, there's a lot of other benefits that come along with that from, health plans and all those other fun things that we get to do. But what are your thoughts from a financial planning perspective?
All right. So when it comes to making this decision here, typically taxes are something to consider, but most people don't make the decision based just on taxes. The answer that I've seen for clients is it depends. Like Chad said, when him and his wife got together, it actually cost them more in taxes. What I do see for most individuals when they do get married, tax brackets do tend to go down. So for most individuals, I do see them being able to save more on taxes just because you have higher tax rates, or so you have higher income thresholds. So for most individuals, they're paying less in taxes over time, but that's certainly not the case for everyone. You'd have to compare both side by side with a financial planner that does taxes or a CPA to really get an idea for your individual situation.
Yeah, and
Go ahead.
sorry. Oh, okay. I just wanted to add something real quick. If the question is more asking about married filing jointly or married separately after they do tie the knot, then it's 9 times out of 10 better to file jointly. There are nuanced cases if you're, for example, burdened with a lot of student loans and you're part of an income-based program to get that paid off, then it might be more beneficial to actually file separately in that case. But as to what Paul was saying, we do want to do some scenarios about what would be more beneficial for you. And that's really just sitting down with you, your most recent tax return, and understanding what those projections would look like over the next tax year to better understand your situation.
Cool. So the next one I have for you all is just thinking about a mortgage payment. Like, what's a reasonable percentage of net income for a mortgage payment? And be sensitive. We have a nationwide audience. So from California to Phoenix to Wisconsin might be very different.
You're talking as a percentage of debt?
No, of their income. So if somebody makes so much money, like how much of their income should go to housing, right? I mean, it's beyond mortgage.
Yeah.
I mean, that could be rent, etc.
Rule of thumb's typically 25 to 35%, depending again on the state and so on.
Yeah, realistically, in more expensive states like California, New York, it is harder to do because if you're 2,500, if you're trying to keep it at 25% and your net income is 10,000 a month, you're getting a mortgage of $2,500. The definition of a millionaire in California is a homeowner, so that's going to be a little difficult. I would say try and keep it less than about 40 to 50% of your total net income. Because if something happens to you and you collect disability, disability only pays out 60% of your total income. So if you're used to getting 10,000 a month, you're on disability, you're now only going to get 6,000 a month. If your mortgage is 50% of your net income, that's $5,000 a month. That just leaves you $1,000 a month for groceries, utilities, and everything else. So it is difficult, and it is really going to be very based on where you live. But a lot of clients that I've seen I work with, especially in areas like Nashville, Texas, Florida, Ohio, areas, a lot of clients there, they have the ability to afford more, but they're keeping, especially for a first-time home purchase, keeping it at that 25 to 35% gives you a lot of room for growth, gets you into a starter home typically, and then that's a starter home that can be sold to give you your dream home down the road, or that can be turned into a rental down the road as well. So it gives you a lot of flexibility.
It has been difficult though over the years as just housing prices have appreciated. Mortgage rates have gone up the last few years. So it's been difficult, especially California.
California and New York, although all of you, I honestly, I've been watching the Midwest and those seem to be going up quite a bit too. So next one I have group is if I retire and begin collecting Social Security at age 63, am I automatically signed up for Medicare Part A and B?
I can take that one.
Yeah.
Good.
So the earliest you can be eligible for Medicare would be age 65. And so I think it's similar to the question that was earlier, right? So if you're 63, right, you're not automatically enrolled. So for Medicare, there's actually 5 or 6 different types of enrollment windows and periods. I don't know if we have a slide on here. Depending
No.
on, there's an annual and open enrollment, and then there's like the special open enrollment if you're qualified, if you quit your jobs, terminated from work, et cetera. But you do have to be at least 55 in order to apply for Medicare. Just keep in mind that if you do happen to miss your enrollment window, there may be a penalty. I think specifically to Part B. And so there's a specific calculation that they do, going back to the months. So that's just something to be aware of. Anybody else wanted to add to that?
Yeah, so you're not eligible until age 65, as Sophia said. And when, let's say you do collect Social Security at 65, you have to choose to enroll in Medicare. You're not automatically enrolled. And so when you start Medicare, you also have to choose which parts you enroll in. So like parts A and B are the two basic ones. A is something you pay into over your lifetime. It's there. And that's really for inpatient inpatient. So anything that keeps you in the hospital, that's going to be covered by Part A. Part B is everything else that's not in the hospital stay. You have to enroll for those separately. So something I do see if you're like 65 plus and still working, kind of the opposite of the question here, you may enroll in Part A, but not enroll in Part B until you retire from your employer. So it is kind of a very nuanced question. We did do a full webinar with Brian MacArthur, who specializes in this past summer. If this is something you're looking at or getting close to Medicare age of 65, I would strongly recommend that you do check out that replay.
I will find that replay link and post in the chat box in just a few minutes for anybody that wants to click it. Like I think you cannot copy out of the Zoom chat box, but I know you can click it, put it in a browser, and then copy it out there separately. But I'll put it just in case somebody does want to look at that. All of that is on our YouTube channel, by the way. The next question I have for the group is, this goes back to investing. What's your take on investing in high dividend stocks? And I mean, they put a ticker in here, but I think just generally, like we don't need to pitch any specific company, but just high dividend stocks, like individual stocks. What's your pitch?
I mean, we typically try to get our clients to focus on total return. You start to narrowly only invest in high dividend stocks. You're going to be left out when those stocks lag. And like we've seen the last 12, 24 months, growth stocks doing really well. So we focus on having dividends as part of our investment portfolio, but also on appreciation. High dividend yield stocks, sometimes you can get caught in those kind of traps of, hey, this is paying a high dividend. It's probably because it may get cut soon. You have to look at what the dividend coverage ratio, and I mean how much of their earnings and so on are going to dividends, and are there fears about it getting cut. So dividends are an important part of investments. I think historically speaking, about 25 to 30% of the S&P 500's returns have come from dividends. So it's important, but it should probably not be the sole focus of your investment strategy.
Yeah, Mike, I'll add just a bit onto that too. I mean, you kind of touched on it. High dividend could be a sign of trouble as well, and that's what we really want to caution you on. There could be a number of factors that could cause that high dividend, and Mike touched on a couple of them. The other is simple mathematics, right? Like if you are in a stock that is paying 8%, but that stock has been on a very lengthy downturn, greater than 8%, you're holding on to a dividend at the expense of, your cost in that stock. So we would encourage you to think about dividends in the way of just total return, as mentioned. Think about, what's called the aristocrats, those that tend to increase their dividend over the years. But when it gets too high, kind of like what our moms told us, right? Like if it looks too good to be true, it probably is. And so just use a lot of caution, a lot of research when you see those high dividend stocks.
Okay, so the next one is not at the top of the Q&A box, but there's a few questions on the same thing, so it would be if they were thumbs up. So this goes to annuities. Are annuities a good investment? Right, this person specifically calls out. There's a lot of free dinners offered for those insurance presentations, and then because I know the answer you're going to give, right? It depends, and not always for most people, but for somebody that it does make sense to, like any suggestions, like we don't sell annuities, so any suggestions on where somebody might go to purchase an annuity?
Yeah, there's a couple examples, like if you're making sure that alimony payments would get paid out as one example. It's really dependent also on if you want to guarantee some of your fixed expenses in retirement, like your property tax payments that even if you pay off your mortgage, those don't go away for you. So it's looking at more of those things. I wouldn't look at it as an investment. I would look at it more as a replacement for your cash flow, like a pension. And it's more just understanding, again, what Chad is alluding to, it depends kind of answer. And really, we just want to understand your situation to see if it makes sense. And one, if it does, then what kind of annuity would be appropriate for you? And kind of what the question was also alluding to is that because the annuity marketplace has a wide swath of different types of products, I wouldn't buy an annuity based on where you have that steak dinner. Really? You want to understand what you're buying, similar to with any insurance product, before making that decision, because those contracts can be 300, 400 pages long. And I guarantee you, in the amount of time I've been in this industry, nobody on that has bought an annuity has actually sat down and read all 400 pages. You always have to explain it every time to the person what they bought. So annuities are not bought, they're sold. So keep that in mind as well.
Yeah, especially those stake dinner ones, they likely carry higher fees. You got to be aware of surrender charges and illiquidity. We've seen surrender fees go out 10, 15 years. And that's to recoup the commission that the person earned selling that annuity to you. If you are looking at annuities, I recommend finding a broker that can shop around and get the best deal for you. And also just one other thing on annuities is distributions, as highlighted here on the screen, are tax ordinary income, but they grow tax deferred. There's so many times we see annuities in tax deferred accounts, like an IRA, and it just gets rid of that one of the benefits of an annuity. So
Yeah,
anything
I
else?
have
Yeah.
I actually have a real life example. There was so I work with a lot of institutional participants, right, from a lot of our institutional employers. And one of them, when we met, she actually had two annuities in her IRA, to your point, Mike, and totaling about $700,000. But the problem was about 5 years ago, that annuity, that insurance company actually went under. And the person who sold her the insurance, the agent, is still in the business, but he wasn't aware of it at all. So she had to kind of find out through, the legal letters and everything, because now, her money is locked up. And, so when we are doing her financial planning for her, it pains me to really see that a bulk of her assets in retirement, $700,000, are just kind of locked up in limbo, right? Because they're now in court, and so again, right. I think to Henry and Mike's point already, there's a lot of hidden things that are just embedded in annuities, and so definitely if you have already set up your mind, you're going to purchase it, right? Then at least do your due diligence on these insurance companies to make sure it's at least an adequate, or a long-term company that will be there still, because that's the whole point of having that guaranteed stream of income. That's just what I wanted to add.
Yeah.
Yeah, I mean, it's the last things I'll add is that to wrap up that one is they come at a high cost, right? There's a big commission that somebody makes when they sell that annuity to you. So on the other side, that there is something said to be for peace of mind, right? For some people, they make a lot of sense. If you need to make sure you can cover some fixed expenses for the rest of your life, just be very cautious when you're getting into new. They have a really bad connotation because they were sold to people that never needed them for so many years. But even today, there is still some people that they make sense for.
Yeah, just keep in mind, guys, annuities, right? Life insurance is in case you pass away prematurely. Annuities were originally created hundreds of years ago to give you a paycheck for life so that you don't outlive your assets. They've morphed into this hybrid product today where they're now being used as an investment vehicle. And that's not a very good way to go because of the high fees and other problems that they have.
And last thing I'll point to, Henry mentioned it earlier on a separate one. Paul, do you mind flipping to the next slide? The index annuity, those are the ones we're seeing most today. It used to be the old variable annuities. Those have high fees, and you carry more of the investment risk because you make the investments yourself based on the menu of options. But index annuities are tied to some type of index like the S&P 500, and unfortunately they get sold as you've got no downside and you get the upside of the index, and no fees. There's no free lunch. The fees are baked into the product and the caps of the annuity. And as Henry, there's lots said earlier, there's lots of pitfalls. What that cap is, how it's calculated on a monthly, annual basis, doesn't include dividends. There's lots of things, different features, and it takes a rocket scientist to get through those 400 pages and understand how that return is getting calculated. So just be aware of those, because we are seeing a lot of those. And again, they may be right for the right person, but just depends on your situation.
That one touched almost everybody here. Next question I have for the group. Again, way different topic. So just putting in perspective, at the beginning of a mortgage, you're paying a lot more interest than principal, right? So regardless of what the interest rate is, and that might not be the case, maybe interest rates do matter here. Does it make sense to pay some of the principal early if you're able to afford to do so?
Scott, you want to take this one?
Yes. The short answer is yes, it does make sense if you have the ability to do so. So, right, as mentioned in the beginning of the mortgage, a lot of that is interest. And so when you look at the cost of your mortgage plus the interest that accumulates over that period of time that you have the mortgage, the interest payments that you make over time are pretty darn significant. So if you have the ability to pay $100 more a month, $500 more a month, what have you, even at a low interest rate, it's less about the interest rate and it's more about the overall cost for the term that you have that mortgage. And you can cut your costs significantly by doing so if you're consistent with it month over month, year over year.
I personally, I mean, we pay an extra $150 a month to our mortgage, and then we do one extra payment at the end of the year.
It's not uncommon, clients that we've encountered in the past that might get a quarterly or annual bonus to also make that as part of their contribution, just a one-time contribution. But yeah, anything you can do to chop down that interest over time it's significant over time.
You can shave years off.
Yep.
Mm-hmm.
Cool. Next one I have for you, this goes to college saving. Are there ways to save and or pay for college besides 529 plans? I've heard this person that you can use tax-free withdrawals from insurance policies to pay towards college. So I think maybe two parts to that question.
Yeah, so this kind of comes back to the insurance agent is trying to make a sale, just flat out. That's kind of what they're trying to do. So you can kind of make the argument that the cash value buildup grows over time as you put in money into the policy, and you eventually take loans against that cash value, which is what the actual tax-free withdrawals are. Why they're trying to look for these alternatives to 529s is frankly because these cash value policies and how they're structured are pretty sizable commissions for the person selling the policy. You see it more often than not, to be honest, and I do come up across this question more times than not because people are looking at 529 plans and saying, okay, well, if my child doesn't go to college, what are some options? If they choose not to go to college, what if they want to start a business? That quote unquote strategy from the life insurance policy just offers other avenues because the insurance agent would come back and say, oh, well, those withdrawals don't have to be towards college. They're tax-free towards starting a business when they first get started or whatever they want to say from there. So really what they can do is there's taxable investment accounts that they can start where they earmark for themselves as the parents, just a general investment account that grows over time that can be used for whatever they want. Or if there's anything else anybody would like to add to there, but frankly, college planning takes a little bit of nuance to understand.
Yeah, I think sorry, for 529s, I mean it is by far, the most popular college savings vehicle out there. And I think the main concern that people have, regards to 529 is, well, what if I have leftover assets, right? After all my kids go to college, or perhaps they don't like the limitation that it's only for qualified education expenses. So first of all, for K through 12, you are able to use up to $10,000 per year towards qualified education expenses, right? So it's not only for, higher educations. But with the Secure Act 2.0, I think there was a clause in there that says, first of all, the 529 has to be open for at least 15 years. And then, so if I'm the parent and I have the child is the beneficiary, right? And let's say for some reason, over the years, the contribution was so great that, I know that I'm going to have leftovers, even after my child goes through college or higher education, whatnot. So then the Secure Act 2.0 says basically me as the sort of account holder, or I can't remember the name. But what I can do is I can then transfer, I think, up to $35,000, right, into an IRA for the beneficiary. So in this case, for my child, right, into an IRA. There are some sort of a little bit, it's nice to have that little bit of a option or flexibility there. But also, if you have multiple children or other family members, it's not uncommon for you to rename the beneficiary, and maybe for your niece and nephews, or yourself if you ever want to go back to school, etc., right? As long as it's qualified expenses, you can certainly do so. On the flip side of things for life insurance, I have seen it worked properly where my old colleague, he was 37, and after his grandfather started out a life insurance policy for him when he was just a baby. And so over the years, right, you can imagine 30 some years to cook that thing. And so by the time he went through school, he went to UCLA, he still had something left over in that policy. And then later on, he was able to use that cash value, or taking a loan against that policy, and to make a down payment for his first home. So, we're not trying to be like anti-life insurance per se, because, we have seen it work properly, appropriately in its situations. But I think the key thing is you want to make sure that the item or the policy that you're purchasing is designed exactly according to what you wanted to do, so that it's not just another policy that someone is trying to sell you, because we see that a lot of times when it's not designed properly.
I would just add real quick. We think 529s are best for college savings, but a Roth IRA is another alternative if you're looking for one, if as long as your kid has earned income, because those can be used. The contributions avoid the 10% early withdrawal penalty for college tuition. So just one alternative out there.
Yeah, and I think while we're there, because I mean, there's another one like UTMA and UGMA and all this stuff. So I did actually put a link that actually Paul, one of our panelists today, wrote in our blog and back in 2022. So the limits are a little bit dated at this point, being a couple years later. But I think the rest of the information is still really good for anybody that's interested in this topic. I did put that in the chat box. Just the best account to open for your kids, and it talks about 529s versus UTMAs versus the Roth account that Mike just mentioned. And kind of the pros and cons of each, and like when you might want to think about one versus the other. So definitely a great resource from a couple of years ago in our blog. I know we did just cross the top of the hour too, so we build this for 90 minutes because we know we get so many great questions all the time. So we're still staying on the line, but for any of you that do need to drop because it did cross the 60-minute mark, I did also put in the chat box a link to that 1 to 2 minute survey I mentioned. Please do let us know your feedback. Was a full Q&A process or session something that was valuable? Any topics you might want to see from us as we start to prep for next year in 2025 and our next summer and fall webinar series? The next question I have here is, and I got 2 back-to-back on Roth for you all. First one is losses in a Roth IRA. Can you write those off in your taxes? Should be low-hanging fruit. Who wants it?
The answer is no. I wish we could, but the Roth grows tax-free. So it's tax-free. It'd be great if we could grow tax-free and still take the losses, but unfortunately, that's not an option.
Yeah. And so just because it's related to Roth, I have another one here that can I use the backdoor Roth for my contribution instead of directly putting money into a Roth? Can you guys explain how that works? And I don't know if this person's over the income thresholds or not, but just thoughts on how somebody can accumulate a Roth account using backdoor.
Yeah, I think the question is alluding to how do I do a backdoor Roth?
Yeah.
Because I mean, if you have the ability to contribute directly to a Roth IRA, that means that you're below the income limit that Chad is alluding to here with the slide. And if you're above that limit, then you just have to get more creative. Really, what you're doing is you're making a non-deductible IRA contribution and then immediately converting that into your Roth IRA that you're either setting up or already have established. So that's the difference between the two. The other thing to look at if you do have the ability with your retirement plan is maybe making Roth contributions into your retirement plan, since there is no income limit to make Roth contributions to your retirement plan, say Roth 401k, Roth 457, whatever the case may be in your case. So that's how that works.
Yeah, I'm going to do 2 on that to add is I think there's this huge myth out there because people hear like once you make over $150,000, you can't contribute to your Roth IRA anymore. The myth is that applies to Roth 401ks, Roth 403bs, and Roth 457s, and it does not. So you can make $20 million a year and still put that, I think in 2024, the limit was $23,000. 2025 is $23,500 into a Roth, right, employer-sponsored account. There's no income thresholds. And if you're over age 50, you can actually increase that by $7,500. So somebody age 50 plus can save, almost $30,000 into the Roth 401k or similar account, no matter how much money they make. One question I get from the group is, so somebody's over that income threshold, they want to do a backdoor Roth, but they don't already have a Roth IRA set up. If they're over the income threshold, are they allowed to set up a Roth IRA to facilitate this backdoor process?
Yeah, you can set it up. The money has to come from the traditional IRA. Can't come directly into the Roth.
Right. So you set up one non-deductible traditional IRA, set up a Roth IRA, put the money into the traditional, and then move it over. Right. So it's just a multi-step process.
Yeah. Unfortunately, it's a shell game the IRS forces us to play. Before the TCJA, this was a gray area. This as part of the Tax Cut and Jobs Act, or I think it was that I can't remember if it was the Secure Act or Tax Cut and Jobs Act. Sorry. But anyways, it was created into law. So it is no longer a gray area. It is fully allowed, but it's just the game that the IRS requires us to play if you want to make them.
And I would just add, when you do that backdoor, you move it immediately from the traditional or non-taxable to the Roth immediately. You don't want to wait on that.
And if you have IRA balances, so if you already have an IRA with $1 million and you're going to do this, you might actually trigger more taxes. There's what's called an aggregation rule. So when you do a conversion, if you already have a lot of IRA assets in an IRA that's traditional, part of that would be considered also. So you may be triggering taxes on that conversion.
Okay, so the next question I have for the group, again, switching topics. This goes back to Medi-Cal, Medicare. What is the look back provision in these two programs? And is there a trust or similar way to plan for this for parents?
So yeah, I'll take this one. You can do planning in California. It's Medi-Cal. Rest of the nation is Medicare. There's two parts to this question. Okay, so for the look back period, this is how far do they look back at your assets to figure out if you qualify because you meet their minimum thresholds. The look back periods for Medicare, at the government level in most states is 5 years. For specific to California, the look back period is 30 months, 2.5 years. So California is a lot friendlier than most other states in qualifying. There is planning that can be done, but let's say you have a spouse that has dementia and you want to help get them qualified to help cover the cost for the care, and you're going to have to wait that 2.5 years. Otherwise, it's going to be a disqualifying event. There are attorneys that specialize in this. You want to find an attorney that specializes in senior care or senior law to help you with this. It is a very complex transaction.
So next one I have, and again, I have a couple of questions on it, so it would be the top of our Q&A. So I'm going to lump a couple together. But what are your guys' thoughts on investing in real estate? And I'm going to put a couple pieces together here. One is California, one is other nation, though. Just thoughts on having a second property. That's why I say when investing in real estate, like you have your primary residence, we consider that your primary residence, but buying a second home, renting it out, how is this treated, right, when somebody passes away, right? Just your thoughts generally on a rental property. Maybe start with Mike, because I know Mike used to have one and he doesn't anymore.
As a year and a half ago. A rental property could be great. This is a second home just owning, but I mean, there's potential for capital appreciation income, you want to make sure that the cash return, your return on investment is above what your opportunity costs or costs to invest it somewhere else is. I mean, if that's treasury bill CD or just investing in the market, there's write-offs that you can do, so there's tax advantages there as well. But being a landlord is not fun all the time. If you hire a property manager, there's added costs there. Stuff breaks and you have to have reserves to fix stuff. And then certain states like California, it's very pro tenant. And you hear those horror stories of squatters and kicking people out, and it takes 18, 24 months. So it's very, specific to the state that you're in as well, and just know what the rules are there. But there's a lot of advantages, but there's disadvantages as well. Paul, anything you want to add? I know that's near and dear to your heart as well.
Yeah, so there's analysis that can be done, like Mike said. Right now, if you're not getting a 4% return on that, and if you have questions about this, reach out to us. We can help you with analysis. But if you're not getting at least a 4% return, it's not worth it. Most clients right now in California, when we do the analysis, we're seeing the returns in the 2.5 to 3% range right now. So less than what you get in just investing in a risk, putting in a savings account or investing in a T-bill. Is given better returns than real estate in California for the most part. There's always exceptions to everything. Okay. So that's just kind of what you got to watch out for. Moving to more landlord friendly states and states that have lower cost of living tend to be better return on your investment.
I think the inheritance piece we didn't touch on, that would get a step up in basis as well.
Correct.
Yeah.
Cool. Okay, group. So the next one I have here for all of you, and I'm going to, again, I got like two that are the exact same, so it would be at the top of our box. This goes to the 10-year rule. And it's two-part. This person has a 457. Does the 10-year rule apply to 457 plans? And also, does the 10-year rule apply to an inherited Roth account?
Yeah, so it applies to any of the inherited assets, and the 10-year rule starts, when you inherit it, you have a required minimum that you have to satisfy each year. And then in that year 10, then you have to deplete the account. So what we do with some of the planning is it might be more beneficial to take more than the required minimum distribution, because we're looking potentially at a tax bomb if you're just doing the required distributions. And if it's a large balance, then in that last year, if it's an inherited IRA or something like that, then it would be all taxed at earned income. In the case of the Roth, you still have to do it, but there is no tax applied on it because it's tax-free.
And so along that same line, so just got a thumbs up there too. When can I withdraw from a Roth account? Like, does the 5-year rule apply based on like, it says how the money source is. I'm assuming that means when the money's invested. And I'll answer that question. Like that, it's basically when the Roth account is first funded starts the 5-year clock. And so in the even better thing is that it starts actually January 1st of the year you funded it. So if you funded it January 2nd of 2024, the 5-year clock ends 5 years later, right? In 2029. If you funded it today, November 13th of 2024, the clock actually started January 1st of 2024. So it's still, the clock expires 5 years later in 2029. But yeah, that's when you can take it out. The 5-year clock just starts on the day the account is first set up and funded.
And 59 and a half.
Well, and 50, that's fair. Otherwise, you'll have penalties, not on the amount you contribute, but on any earnings, you'll still have those penalties for early withdrawals.
And just going back to the prior question real quick on the 10-year rule. Yeah, if you inherit a IRA or Roth or 401k, 457b, that 10-year rule is going to apply. If you inherit an inherited IRA, someone already that passed away, that's going to continue on that prior one. The clock doesn't restart at 10 years. I just want to make sure we're clear on that.
Yep. Next one that I have for you all, this goes back to investing. Large caps seem to be doing better than mid or small caps. Do you still recommend staying diversified? Let me throw that to our portfolio manager, Mike here.
Yes, we see cycles of outperformance. We've seen that in the past. We believe studies done by Fama and French of different factors over time. We've seen value, size, small cap versus large cap. We think those continue to persist into the future over a long period of time, but we go through periods of underperformance, and it stays. We think we're staying diversified because timing those factors of when things are going to outperform is very difficult. And just coming to currently, I mean, valuations are always the best indicator of long-term returns. When something's cheaper, you should have better returns in the future in that asset class. And when we look today at small and mid-size companies here in the US and internationally, valuations look more fair to even slightly undervalued. Whereas large US stocks are selling at a higher multiple. So just, yes, makes sense to stay diversified.
Yeah, let me add to that. And I think like large cap has done really well, especially over the last decade or so. I think the catch I'd put there though, it's not all large companies, right? I think especially the last 5 years has been large cap growth and big tech that's done really well. You think, I mean, there's a term out there in the market today, Magnificent Seven. In 2015, it was the FANG stocks, and they're the same, like 5 to 7 stocks, right? Facebook, Amazon, Apple, Netflix, Google. Today, you tack on artificial intelligence, like NVIDIA is part of that now too. But that's what's really driven markets. Large cap value has not done nearly as well. So it has been a tale of which large companies you're investing in. And like large companies have generally done better than mid or small companies over the last decade. But again, as Mike mentioned, they go in cycles, right? And there's a point where small caps and mid caps grow to become large companies, right? And so being in the right small companies, right, can be a great long-term strategy. Yeah, the same thing international, right? US has reigned supreme for over a decade. But the prior decade, international stocks reigned supreme over and outpaced the S&P 500 and US stocks. So I think our approach is stay diversified. I would say, I mean, Mike, from a construction perspective for portfolio, do you still put more in large companies, right, and kind of scale down? I mean, the typical math I see is something like the Russell indices, right? 70% large companies, 20% mid-size, 10% small size.
Yeah, we take that core and satellite approach where the core of your portfolio is still going to be large US companies and US bonds. And then you kind of have those satellite smaller positions, again, depending on your risk tolerance and time horizon, where small, mid-sized international companies will make up a smaller allocation. And just going back to an example like 2000 to 2010 during the dot-com bust, large stocks in the S&P 500 pretty much went sideways during that decade, and small and mid-sized US companies and international stocks outperformed. So we see these cycles happen. So I just using that as an example.
I love it. Next one I have here is I did not pay into Medicare while working in government. What will my premiums be when I reach age 65? Any idea?
Yeah, I was just recommending that you speak with Brian MacArthur that we mentioned earlier in the webinar. He's a great resource for Medicare planning because it's more of a broad question. We also want to look at things when it comes to Part B and Part D, the impact that your taxes have on those premiums and how that works is dependent on your modified adjusted gross income. And it's a 2-year look back. So it's unfortunately not as simple as just here's what your premium is. We just have to understand, at least for Part B and D, what your income tax situation looks like in retirement to better understand what that actually is for you.
So the next one I have here, group, is there a formula or calculator for how much someone should save monthly if there's a specific retirement number they're trying to hit? And then related, right, is that 4% rule that everybody used to talk about? Is that still a rule of thumb?
All right. So there's not an easy calculation. I mean, I guess if you want a good, easy, simple calculation, take whatever your current expenses are. So let's say your expenses are $80,000 a year. You're going to get $30,000 in Social Security. That means you're going to have to cover $50,000 in expenses in retirement from yourself. If you take 50,000 divided by 4%, that would give you a ballpark in terms of how much you should save. The idea there with that is what's called a perpetuity calculation. What that's saying is at that amount of money, you should theoretically never have to spend down principal. You should always see the account growing in retirement, theoretically. The actual number you need is probably less than that. But if you want a simple, easy benchmark, just figure out what your shortfall is going to be in retirement that you're going to have to withdraw from your portfolios, divide that by 4. That'll give you a ballpark. That's the simplest thing that I can think. The 4% rule itself, it's still around. Advisors are still pushing it. In a time of higher inflation and higher interest rates, there has been some discussion internally within academia for us nerds that are financial planners about does that still hold today? Most advisors will quote it because it's been around for a long time. There is some concern that if we see a period of high inflation and high interest rates, you're probably going to have to keep your spending rate closer to like 3 to 3.2%. But again, that's not a situation we're in today, so I'm not trying to scare anyone.
Yeah, and just want to add something as well. There's also the philosophy of dynamic spending. So in years where the market's doing well, it might be more advantageous to spend more than 4%. Maybe it's 5% in that year. You go on that more elaborate vacation that you had planned out, for example, and then in years where the market's not so good, you're just kind of camping in your backyard. It just really depends on what's going on in the market at that time. So unfortunately, there's no steadfast 4% rule, but it's a decent compass though.
Yeah, I
And
would
if
say this is a starting point for a lot of people, right? To give them like a basic guidelines in terms of how much they need to save, start thinking about retirement, like what their expenses will be, etc. Right? Ideally, how much would you like to spend in retirement years? But I would say after you get this, starting really to meet with a financial planner and to go through the financial planning process, because everybody's investment risk tolerance, everybody's goals and situations are so different, so we're not saying that this 4% rule is like a one size fits all, but it's certainly a good rule of thumb or like is a starting point.
And just for savings, again, going back to when we kicked off this call, start early. Your savings rate can be a lot lower. Whereas if you wait till your age 40, 50, and you're trying to start saving for retirement, you're going to have to contribute at a much higher rate to play catch up. So start early, and we typically try to recommend, saving around 10% if you can. Or even higher. So, but it's all specific to everyone's situation.
We just got a few more in the queue, actually. I'm going to address one of them quickly because I think we just did it, but just in case, because it came in after we answered the question, is if I add a Roth contribution or make a Roth conversion to an existing Roth account, does that impact the 5-year rule? The answer is no, right? Your Roth account, the 5-year rule started the day you first funded that account. Any new money you add to it as part of that same rule. The one caveat I would do is if you added money, and I guess put this to the CFPs, if you set up a Roth 401k with your employer that's only existed for 2 years, then you leave or retire and roll that into a Roth IRA that has already met the 5-year rule threshold. Is that employer Roth money subject to the same 5-year rule of the IRA, or is it subject to the 401k 5-year rule?
It's going to be based on the original time that the account was open.
So it all goes back to that IRA. So it's like
Correct.
maybe
Yeah. So you want to start that clock as soon as possible. So if you're sorry.
I was going to say, but on each conversion, the 5-year rule applies to each conversion. It doesn't go back to the time opening it.
Yeah, and let's be clear here. There's technically 2 5-year rules so this whole thing gets really kind of confusing. So there's technically 2 5-year rules that we have to get into. That's going to be a 10 or 15-minute discussion. If you do have more questions on this, reach out to us. We're happy to clarify your individual situation. Hope that answer for you individually.
So just think, I put the easy summary though. You set up, everybody should set up a Roth account just in case, even if you just put $1 into it to start, because it kicks that 5-year clock, right, for that account. Any original Roth assets that you move to that account will be subject to that account's 5-year rule. If you convert pre-tax money to Roth, even if it goes to that account that already has 5 years, the converted money is going to kick off a new 5-year clock, basically. Again, there's a lot of complicated math there too. So original Roth assets, original Roth 5-year rule, conversions are treated differently.
Which is why we technically would want to open up a separate account, just because the clocks do get complex. So, yeah.
Okay, last two. First one is, when is the last day someone would need to completely withdraw like 100% of their assets from an IRA, 457, 401k, etc.?
I'm going to be 50 the day you die.
Yeah, so there's no requirement, and I think there's a big myth out there, right? Somebody retires and you have an employer 401k and you're going to take it all and put it under your mattress in your savings account. The reality is a lot of people leave their money in their employer-sponsored account. A lot of people roll it to an IRA, manage it themselves. A lot of people roll it to an IRA and hire a financial advisor to manage it for them. You could do any number of things. It's like 100% at your will. There's no requirement to do anything with that money, though. I think the exception is if you have a small balance, an employer, a balance less than $7,000 when you leave employment can force you out into an IRA. If your balance is over $7,000, they cannot kick you out. So you can leave it, you can move it. It's at your will what to do with that money.
Yeah, and then those required minimum distributions that start at age 73 and eventually moving up to 75. Those are based on the year-end balance as of December 31st, and then an age factor based on IRS life expectancy tables. But you may leave some balance by the time you pass away. That's when you set up an inherited IRA for your beneficiaries, and that's when the 100% goes out.
So the next one I have, we did get another question that came in after that, but what are your thoughts on high yield savings accounts, and especially as it compares to dividend stocks? So I would first do high yield savings accounts, maybe secondarily, say as it compares to dividend stocks, and where should I put more money? If you just give somebody a tip.
I'll take this one. You should build an emergency reserve of 3 to 6 months. And that should be in a liquid high yield savings account. Today, those typically are paying, call it around 4 to 4.5%, give or take, is a competitive rate. Outside of that, you should be any near-term goals, car purchases, travel, home remodels in the next year or two. But you should be investing any excess reserves in stocks and bonds based on your risk tolerance. Cash, while it's paying today, that rate will likely continue to move down. And as we've seen over a long period of time, cash has not outpaced inflation. And that's our assumption in the future as well, that it just won't keep up with inflation. So for long-term investing, yes, you should own stocks and bonds. Cash is there for immediate needs, goals, and your emergency reserves that typically we recommend 3 to 6 months. For retirees, that may be more like 6 months to a year.
And just to put a number to that, if it's 3 years or less, there's no reason to invest it, in our opinion, just because it's a short time period and the market can go up, down, or sideways during that time. If it's longer than 3 years, it's looking at your risk tolerance and understanding how much you have left to invest, and then constructing that portfolio from there.
Hey, group. So unless another question comes in, this is the last one we have in the queue right now. So I'll let you know if another one comes in, but this goes back to Roth accounts. How many times can I max contribute to a Roth account and pull the same amount in the same year? For example, $5,000 in, $5,000 out.
There's no benefit to that. The whole benefit of the Roth is to put the money in there, get that tax-free growth over time. I mean, just as an example, if you put in $5,000 a year over 40 years, you would have contributed $200,000, assuming a 6% growth rate. That Roth account, that $200,000 that you invested, has grown to about $800,000. That's $600,000 in growth. If you're putting the money in and taking out in the same year, there's no chance for it to really grow. You're not really getting any benefit. You're better off just putting that money in the savings account.
You could do it as often as you want. Again, there's just no benefit to it.
Yeah, that's how I was going to summarize it. That was like, I mean, yeah, like, as much as you want. How many times? As often as you want, like every month if you wanted to. But I think the benefit of Roth is tax-free growth, right? That's the difference from pre-tax savings, right? Pre-tax savings, you put $5,000 in, you get a tax break today, but when you take the money out, you pay taxes. Yeah. The benefit of Roth is that the growth is tax-free.
Yeah, and I guess reading into the question a bit more, technically the contributions themselves are tax-free and then you can withdraw it at any time. It's the growth on the funds themselves that's subjected to the 5-year rule and then the pre-59.5 penalty. So if you want to play that complex game of doing that every year, you technically can do that. I'm exhausted even talking about it, to be honest with you. But you can do that. That is something you can definitely do. But just to keep it simple, you put it in the Roth, it grows tax-free, and you reap the benefits later in your lifetime.
Awesome. Well, group, that is the last question I have for the group. Thank you, all of you, Mike, Sophia, Henry, Paul, and Scott, read in order that you show up on my screen, not in any particular order there. Thank you for all your time and expertise. Hopefully all of you left on the line today found that very useful for you. I mean, we still have well over 50% on the line still, so really good. Thanks for staying with us for over 90 minutes. And hopefully you found it beneficial. We did put on the screen just contact information. I did post it in the chat box several times for those of you that want to reach out directly. There are some questions that I typed direct responses back so that we don't publicize our own services on a live and recorded webinar. And then again, we have one more webinar in this fall series next week, navigating your retirement plan. So for all of you in a 401k, 403, 457 plan, definitely tune in. There's gonna be a lot of great information about just what to do and how to save and how to invest inside of your employer-sponsored retirement program. Again, thank you, everyone. We hope you have a great rest of your day.
Thanks, guys.
Thank you, everyone.
Thanks, everyone.
Thank you.